After seeing the Federal Reserve raise the federal funds rate faster than any time in history, going back starting about 3 years ago now, we're really starting to see mortgage rates stabilize after they have started to drop that federal funds rate, which means lower interest rates could be right around the corner. So, really, what better time than now if you're somebody that's been waiting or wanting to open a new home loan or maybe refinance your current one to actually start looking at what a refinance really is. In this video, we're going to talk about how a refinance could be beneficial to you. We're going to talk about what to look out for. And we're also going to talk about how to make sure that you're getting the best option when it comes to that refinance. Now, my name's Jerry. I'm a mortgage broker. I work with clients every single day to get approved for either a home purchase, a refinance, even looking at home equity loans or HELOCs. So this is something that I do day in and day out to track mortgage rates and shop hundreds of lenders across the country to make sure that I am getting the best deal for somebody. So first thing, I really think we just need to put a definition on terms, because when we're refinancing a loan, really what we're doing is we're opening a new loan and paying off our old loan. So in this case, when we look at the actual terms, we're resetting everything with a brand new loan. So really what this means is for most people out there that are watching this, a refinance may not actually make sense right now. Because specifically, almost 75% of Americans have a mortgage with under a 5% interest rate. Over the last few years, we have started to see that percentage drop from somewhere in the 80s down into where it is today. And really all that is because the last few years we've seen mortgage rates higher than 5%. We actually hit a point where when you look at interest rates above a 6%, we got all the way down to about 7% of people. But over the last few years, as we've seen higher interest rates, we've seen people still need to buy homes. People still need to move for work, to upsize, to maybe sell off a larger home than what they need. We've started to see people above a 6% hit upwards of 17% of mortgages out there right now. So if you are someone at least that's below that 5%, that's where a refinance today may not make sense. As of recording right now, we're looking at a 30-year fixed rate mortgage percentage of about 6.5%. So that's why really for most of you, a mortgage refinance may not make sense right now, as we're seeing average 30-year fixed interest rates in the mid 6%. But it's becoming a more and more likelihood of somebody else who maybe is at a 7% in the high 6% to look at wanting to refinance their home. First, like I just mentioned, it may be to get a lower interest rate. Specifically, right now, while this recording is going, if you're somewhere in the 7%, maybe high sixes, depending on your loan type, your terms, you may qualify for a lower interest rate today to be able to save you money. Another benefit could also be to reduce your term on your loan. So if you're somebody that maybe opened a 30-year mortgage a year, 2, 3 years ago, and you've been paying on that mortgage over this time, as rates start to come down, you may want to look at a shorter term because it's actually a lower interest rate if you look at a 20-year loan or a 15-year loan versus a 30. So because you may have a lower interest rate, you may actually have a comparable payment on a 20-year loan than you had on your 30. So you're actually reducing the term by 10 years while keeping a similar payment. That specifically could save you hundreds of thousands of dollars in interest over the life of your loan. There also could be a lot of people out there that could right now have an adjustable rate mortgage. So when you go from an adjustable to a fixed, you can actually lock in that interest rate where you're not going to be at the whims of the market if rates do by chance go up. You could also, as a benefit, look at changing your loan type. For example, maybe you have an FHA loan where you have mortgage insurance. Depending on where you bought, maybe if you've accelerated monthly payments, you may be at a point now where you could refinance into a conventional loan and remove a PMI, where if we have at least 20% down, you don't have that PMI payment each month. And really last thing where we could have a benefit is looking at pulling equity out of your home. Now, that could be to be able to combine maybe a first and a second lien into one payment, because maybe the second lien that you have where you maybe pulled out a home equity loan already is at a really, really high percentage, somewhere in double digits, where we could pull that out, refinance, and put those two payments together. We could also look at options where we could pay off vehicles, we pay off car loans. We can pay down credit cards. We can pay off student loans. So being able to pull cash out could also look at something where we can lower our overall monthly debt if you're in a position where we really need to focus on lowering monthly payments. Because let's say we look at some other debt out there where we have a credit card balance, let's say of $10,000. Well, if you're someone who has that credit card balance, the minimum payment on that credit card might be upwards of three, four, $500 a month. Where if we can pull equity out of the home, roll in that debt, pay off the credit card, that $10,000 in credit card debt is really only going to be about $70 a month in a monthly payment on a 30-year mortgage. We went over benefits. Now we really also need to talk about what to look out for when you're refinancing so you don't put yourself in a worse position overall. The first thing is, what if you owe more on the property than what it's actually worth? What if you use down payment assistance? Or what if you put a minimum on, say, an FHA loan of 3.5%, on a conventional loan as a first time buyer of 3%? And what if the value of the home has gone down to a point where we just owe more on the house than it's worth? We've actually seen over the last couple of years how home values go down in multiple places across the country. Low appraisal values and homes losing value may also hurt somebody in regards to PMI as well. Because if on your first loan, when you maybe purchased a home, you put 20% down and home values have gone down, say 2, 3%, and you're a year later looking to refinance your home, if you do a refinance, you may not have enough equity where you still have 20% owned. And so doing a refinance right now would actually add back on PMI to your loan. Then the third thing that you need to look out for is your actual loan approval. So with every single refinance, you still have to qualify for the mortgage. So if over the last few years, maybe you had an issue when it comes to your credit score, you had an issue when it comes to your income, well, right now may not be the best time until we can actually fix those issues to make sure that we can still get approved. Now, the good thing is with a couple different loan programs, specifically FHA, VA, and USDA, there's options where we may not have to qualify specifically based off of your income, off of any savings that we have out there, or any credit score at all. So you may actually still be able to qualify for a refinance if you've had any of those issues with an FHA or a VA loan. Another thing that we really need to look out for too are either resetting your term of the loan or longer terms on the loan. So if you opened up a 30-year mortgage, let's say 2 years ago, you have 28 years left on the loan. Well, if you refinance into another 30-year loan, you're now going to be adding 2 more years onto your loan than what was originally owed. So that's where we also may want to look at the possibility of reducing the term on your loan, or maybe even keeping the exact same term on it if you're working with a lender that will offer a refinance at specific years. Because there are a lot of lenders out there that will only do fixed terms over 5 years. So, say 15, 20, 25, or 30. There are some out there that will do individual years, like, say, a 29-year loan or a 28-year loan, to make sure that you're not resetting your term completely. The next thing we also need to look out for too are larger loan amounts. So with a lot of lenders that you work with, they may advertise where you have a refinance where there's no cash out of pocket, there's no money out of pocket. You may want to look at when you actually get into an FHA or a VA loan. There's also some fees that are going to be associated with that too, that will generally be financed into your loan amount. So yes, you may be getting a lower interest rate, but be aware that if you roll in some of those costs, we roll in the extra fees depending on the loan, your loan amount may also go up, which obviously is making you owe more money on the mortgage. Then the last thing, which really is the biggest thing in my opinion, is the cost of that refinance. Every single refinance is going to cost you something. Even lenders that advertise a no cost refinance, some might say a free refinance, even, really what they're doing is they're rolling in those extra costs or maybe relying on a lender credit to be able to do that refinance for you. There's still a lot of costs that are associated with a mortgage, specifically when it comes to title and escrow. You have a new title insurance policy. You may have a cost to actually sign the paperwork or settle at the title company. Every lender has their own underwriting, processing, whatever kind of fee they want to call it, technology fee. And then depending on your loan program, there may be a required appraisal, a credit report. So all those fees are going to have an extra just cost when it comes to that refinance. And these costs, when it comes to that refinance, are always going to be different depending on what lender you're working with, where you are, what your taxes, insurance, title costs all are. So, what you really need to do is two things. We need to first, when you're working with a specific lender, you always want to ask on a refinance for a loan estimate. Then, second, you want to go back and look at your old closing disclosure from when you actually bought your house. The loan estimate is going to go through and give you an estimate of all of those fees and charges and everything out there. Then what you can do is you can go back to your closing disclosure and make sure that those fees are pretty in line. Specifically, when it comes to taxes, insurance, all those extra charges that the lender doesn't really have control over, that's where you want to actually get the estimate so you can have an idea what that refinance is going to cost you. Then, when you're going through all of these fees on your loan estimate, let's go through each one and see really what to expect with those fees. So first, page 2, section A of your loan estimate, we're going to look for all of the lender slash origination costs. So first thing that we're going to look at is we're going to check for points. So a point is always considered to be 1% of the loan amount. Really, all I want you to do is points, think of upfront interest. With a lot of lenders, they may say they can get you a certain interest rate that may sound great, may sound way, way below the market value of what interest rates are going for. But they may also be associating points, upfront interest, to be able to take your interest rate from the regular rate and buy it down to that lower rate. Then you need to also check for what they call their fees, because everything here in Section A is specifically controlled by the lender that you're working with. So they may have something called an underwriting fee, a processing fee, a technology fee. All those fees are fees from the lender that they charge to actually do your loan. And this is Section A, like everything that a lender has real control over themselves. So this is the section where you want to weigh options, specifically when it comes to interest rate, it comes to how much the cost is for that rate. Then next section B, obviously right below section A, we're going to be looking at things that you cannot shop for. So these are things that have to be done by a third party to be able to have a verification for the lender. So some big things that you're going to see here are your appraisal. You're going to see credit report fees. You may see flood certifications. You may see a MERS, which is a tracking database of property ownership. So these are all things that are going to be in your loan. They're costs that are there, but really, we unfortunately can't really do anything about it. That cost is just kind of, it is what it is because you're not able to actually shop for those things yourself. Then next section is section C. These are things that you can shop for. So specifically here, what we're referencing to is we're referencing title and we're referencing settlement. Normally these two things go together where the same company does both. So what you can do is obviously you can shop for these items. So you can call around to different title companies that are around you. Obviously do a search, look for reviews on the company, get a reference from maybe a real estate agent on who they use. You shopping these items can actually save you some money because in this section it could save you upwards of $500 to $1,000 by shopping these fees, title company versus title company. Then when you're looking at that loan estimate, section D is really just the total of all the loan costs that are there on the left side of that loan estimate. So this next section, section E, this is going to be all of your either transfer or stamp taxes. They're going to be charged specifically where you live. So someone say, for example, in Florida is going to spend way more on stamp fees than they are in Arizona. So this is an actual cost, but this is something that unfortunately we can't shop for. So these two sections, you can think of these a little bit differently than sections A through C, obviously total in D, and then E, because these are costs that are going to be there anyways with your current loan. So you're always going to have your interest each month on your current loan. And then what happens with your escrow account? So with your old escrow account, when you close your new loan and our new loan pays off our old loan, that escrow account, because we have a new loan number, we maybe have a new lender, maybe even a new escrow company overall too, the escrow account that you currently have, you're going to receive a check back for that after the closing of when you fund your new escrow account too. So there is what's called an escrow swap, where if you look on your current mortgage statement, you'll be able to see how much of a refund you've received from your current escrow because all that money is going to come back to you. Then the last section to look at, section H, we want to look at this section because we also want to notice if there's going to be any lender credits. So depending on what lender you work with, the program, the interest rate, you may be receiving lender credits to actually go towards your closing costs to be able to cover some of these items. That's where, if you hear about any lenders, like I said previously, about them advertising a no cost or a free refinance, this is what they're actually doing is they're offering a lender credit for a specific interest rate or program to be able to cover those closing costs. And when I look at a no cost refinance for somebody that I'm working with personally, what I'm always trying to do is I'm trying to cover sections A through C and then those stamp or the transfer taxes. Because I know that the other costs, the escrow and the prepaid interest, those costs are going to be there regardless if you refinance or not. So, what I'm always trying to do is get a lender credit to cover those costs based off of the program and the interest rate. So, when it comes to really just your professional refinancing strategies, what do we actually do to be able to make sure that you're putting yourself in the best position possible? The first thing is specifically what I just talked about before is if we can end up getting an interest rate where we're getting a lender credit to cover all of those closing costs. So, for example, let's say those closing costs in those first few sections of the loan estimate are going to be $4,000. Well, maybe we have an interest rate in, let's say, a 6.5, where what if we took an interest rate of a 6.75 and we ended up getting $4,000 of lender credits to cover those closing costs? So at that point, now you may be able to refinance to a lower interest rate and not actually have any extra costs in that case. You can, of course, also just pay the closing costs out of pocket. Or maybe with where you are right now, the term of your loan, you want to be able to also look at paying for some points to be able to buy down that interest rate, like I mentioned before. So you can pay points, get a lower interest rate. And maybe you think, hey, over time, interest rates aren't going to go much lower than what I can buy down for. So I'm going to do that. You can, like I said, you can pay all those costs out of pocket if you'd like to. Another option is to roll those closing costs into your loan. So, depending on what your appraisal value of your home is, depending on the loan program, you may be able to also roll in all those closing costs. So, for example, if we have a total closing cost of $10,000, you owe $400,000 on a home. Well, we can now set our loan amount to be $410,000. That way, you don't have to pay anything out of pocket. You get a lower interest rate because you're not taking a higher rate for credits. You're just rolling the cost into the loan. Then you always also want to look at reducing your term on a loan. So if you were originally in a 30-year loan, you can actually figure out if you made all of your payments, you kept your whole loan, how much you'd end up paying for the house over time. It usually ends up being like it really is hundreds of thousands of dollars, sometimes even double the price of the home at today's interest rates. But if you looked at a shorter term, you could end up saving hundreds of thousands of dollars of interest, and you could also end up getting a lower interest rate. When we go from a 30-year to a 20-year, or a 20 to a 15, or even under 10 years, if you can qualify for that, if you're okay with that payment, you're always going to see a little bit of a lower interest rate all the way down. So you may even be able to qualify for a lower term, get a little bit of a lower rate, and then in that case, keep your exact same payment or a very similar payment and cut 10, 15 years off the course of your loan, saving you literally hundreds of thousands of dollars in interest. Next one is you always want to look at being able to remove PMI if you pay it. So if you have a conventional loan and you ended up putting less than 20% down, if you have an FHA loan, always look at the option of maybe being able to put a little bit more money down on the home if you can, and you may even be able to offset some of that equity with a higher appraisal amount. So always consider going into a conventional loan if you have more than 20% equity because you'll be able to remove the PMI payment. And last big strategy that I feel like so many people struggle with is to pull the trigger. If you can get a lower interest rate, if it's something that makes sense, you can lower a payment and let's say even that you're able to receive a lender credit to cover all those closing costs, really do it. Like, you just need to do it instead of trying to get that last little bit of extra lower interest rate or that last extra $500. We really have no idea where interest rates may go. They could go up, down, sideways. Nobody has any crystal ball to know what could happen. So if you're ever in a situation where it's a great deal, where you're going to end up saving money, or maybe even just your break even point, how much it costs versus how much you can save is a very, very little amount. I'm talking like less than 12 months, less than 6 months. Pull the trigger, do it, take the jump. You're not going to have to think about it anymore. You're not going to stress about it anymore. If you're going to get that last little bit of interest, that last little extra bit of lender credit too, if rates come down a little bit more, do it, move on, and save yourself money. So if you're somebody who's considering doing a refinance, of course, what do you do next? What are the steps to take? So first thing is you have to find a lender. We need to compare a few different lenders out there to look at what cost is there. And you need to have somebody that is also going to go through and explain all the pieces of this to you. There's a lot of lenders, there's a lot of other loan officers out there. Of course, I'm a little biased being a broker myself, that really just don't explain the whole process. They don't explain the charges, they don't explain the cost. They're just going to try to sell you on doing that refinance to be able to get that commission. And of course, with me being a broker, my website is down below. I would love to help out to see what position we can put you in to see if a refinance even makes sense, or if it's a situation where a refinance might make sense in the future if rates do come down lower. I have a completely free rate tracking system that goes through and we can decide at what point a refinance will make sense so that we can make sure to reach out the second that it gets to that rate. Then you also want to look for the things that you can shop for yourself, i.e., title company. So what we need to do is we need to contact a few different title companies around you and find out what their actual costs are. Now, for clients I work with, of course, I want you to have the option. You have the right to choose your own title company. If you don't like to, I'll go shop for you. I'll go find that title company that makes sense, that maybe is just the closest to you with great reviews. That way, it's not a huge stress for you to have to go drive, say, half hour, hour away from wherever you live. Then, last thing is go shop for homeowners insurance. Really, a lot of people don't shop for homeowners insurance. They don't compare other companies. They just have their homeowners insurance. They just let it go. Maybe the cost ends up creeping up over time. Maybe with your insurance, what if you don't have enough coverage to cover the value of the house? So, of course, always talk with your insurance agent if you're going to go and refinance. Compare a couple quotes, see if that can end up saving you some money as well. And if you ended up getting all the way to the end of this video, of course, I really appreciate it. Down below, you know what to do with the like button. Click that. Click the subscribe one too. If you are a current homeowner, there's a link down below for you where you can sign up for a couple different things. First, there's a free monthly equity report that I send out to everybody that I work with. We can also set up rate tracking to make sure that you know exactly when a refinance could make sense. If you are a first time home buyer, even, or maybe when you bought your house, you really don't think that the lender, your real estate agent explained a lot to you. You just want to learn more about kind of the whole process and understand it a little bit better. I also down below have a link for a first time home buyer guide, just as a more informational piece, just to make sure that you feel like you're better informed. So, of course, again, thank you. And we'll see you in the next one. We'll end this video with a nice, cute puppy to look at.